Hello. So today we're going to discuss why drawdowns start to feel worse than originally expected. Firstly, when traders start to feel that their drawdown is becoming too large, they start to question their system, and it starts to also negatively affect their confidence. Now, one of the reasons for this can initially relate to their expected drawdown calculations from their backtesting results not matching the actual drawdown that they're experiencing in the live environment. So, firstly, we're going to have a look at a simple example of expected drawdown. So, now we're going to discuss the expected drawdown across a sample of 900 trades within a trading system. So, as discussed, we have 900 trades. Now we have a success rate of 45.8%. The risk for every new trade taken is 0.60%. Then these top two numbers are entered into this formula here, which is to calculate the expected consecutive number of losses within the sample. And the output for that is 11 losses here. This then is used in combination with the risk per trade to calculate the expected drawdown of 6.6%. So this highlights the importance for a trader to have a benchmark like these numbers to understand their drawdown, because if not, then when a drawdown does arrive, traders can start to become uncertain and then doubt the execution of their trading system. However, expected drawdown from these numbers is not the only consideration, and now we're going to look at a structural explanation for drawdowns as well. So it's important to understand that losses do cluster, and it may relate to the portfolio structure, because individual trades may link together under one market theme, and therefore they effectively combine to form one concentrated risk profile. Another important thing to consider is the correlation between positions within the portfolio too. And this highlights that drawdowns are not isolated to individual trades, and there needs to be a portfolio consideration, because the consequences, if not, is that traders start to reduce risk, which is not aligned with their original risk management strategy. They start to change the rules of their trading system and even abandon them altogether. And it's clear to see how these combine to introduce behavioural instability as well. So this highlights the importance of structural analysis so that expected drawdown is understood at both the individual level and the portfolio level too. Asking questions like how concentrated is the risk exposure and how correlated are the positions within the portfolio, because then drawdown can be managed more effectively. Because drawdowns are normal as well, and every trading system experiences them. Therefore, the key is to understand them and not misdiagnose them at an individual level, and therefore maintain consistency of performance over time. Therefore, if you'd like to learn more about drawdown behaviour or structural instability, then I provide additional information in the description below. Thanks for watching today, and I'll see you in the next video.